All right, welcome to the Explainer. So today we are digging into a really fascinating theory. What if a huge, panic-inducing stock crash wasn't actually a crash at all? What if it was a perfectly executed trap? Let's get right into it. Yeah, how can that even happen, right? This is the question that has traders absolutely buzzing. The whole theory we're breaking down today is that this wasn't a real collapse. No, it was more like a carefully constructed illusion, and it had a very, very specific goal.
So this is the number that everyone saw on their screens, a brutal minus 19.25%. A huge single-day collapse for RZLV, closing at a really painful $2.39. For anyone holding that stock, it must have felt like just total capitulation. Like this is it, game over.
But then, this is where the whole story gets really strange. Right after the close, instead of just continuing to bleed out, the price snapped back, like instantly. A true crash, it usually keeps on falling, right? So this kind of crazy, aggressive V-shaped recovery, it hints that there was some powerful hidden demand just waiting to pounce.
Okay, so you've got that rapid recovery, right? Combine that with a record-breaking 61.5 million shares changing hands, and that is our very first big clue. The analysis we're looking at says this wasn't a sell-off at all. No, it was a massive, monumental transfer of ownership from one group of people to another.
And the theory behind it is actually pretty simple. The crash was basically engineered to create panic. The goal, to scare smaller retail investors into dumping their shares at a loss. And who was waiting on the other side of that trade? Well, the so-called institutional smart money, of course, and they were just quietly scooping up everything, absorbing nearly a fifth of all the available shares in just one day.
Okay, so that brings up a huge question, right? If these big institutions were buying millions of shares, how in the world did they do it without sending the price rocketing to the moon? How do you even hide that kind of buying pressure?
So where did all those buy orders hide? Well, the answer isn't on the public stock exchange, not where you and I would trade. No, according to this whole theory, the real action, the real story was happening somewhere much, much more secretive. And just look at these numbers. They are absolutely staggering. Over 61% of the day's entire trading volume, that's almost 38 million shares, was traded completely off exchange, totally hidden from public view. And folks, this right here, this is the core of the entire theory.
So these private venues, they have a name. They're called dark pools. And they're what allowed these big institutions to just accumulate this massive position at those super low panic-induced prices, all while keeping up the public illusion that everyone was selling. But they didn't just buy in secret. No, this was a multi-step plan. The analysis says they also built a defensive ceiling, a wall, right at $2.54. This wall of selling pressure was put there to stop the price from recovering too fast. Why? To give them more time to load up and, of course, to set their trap. All right, so they've got their shares, they've loaded up. Now the next phase of the plan can begin, and this is where they use the crash itself as the perfect bait for a completely different group of traders. You see, for short sellers, those are the traders who bet a stock will go down, this crash looked like blood in the water. They saw what they thought was weakness, they saw a dirt cheap fee to borrow the shares, and they just piled in, shorting almost 24 million shares. They honestly thought they were getting in on a dying stock. But really, they were just walking right into a trap. So now, the trap is set. The institutions have their shares. The short sellers are way over their skis, heavily exposed. And this is where we start to see multiple forces all beginning to converge on one single potentially explosive price point. Think about it. As soon as the price creaks above 250, every single one of those short sellers is now losing money. But the real knockout punch, the kill shot, if you will, the price that could trigger forced liquidations, margin calls, is $3. $3. That's the magic number where their pain goes from bad to absolutely critical. But here's the kicker. It's not just the short sellers who are laser focused on that $3 price. There's another incredibly powerful force at play here, and this one comes from the world of options trading. It's a little concept known as max pain. And get this. This is honestly the jaw-dropping part of the whole analysis. The price that causes the most pain for short sellers, the one that forces them to liquidate, is the exact same price that causes maximum pain for options holders. And what does that mean? It means maximum profit for the big market makers who sold all those options. What a coincidence.
So yeah, this perfect alignment, probably not a coincidence. It creates this powerful shared reason for market makers to help nudge the price up towards that $3 mark. This can set off something called a gamma ramp, which is basically a huge feedback loop. See, to protect their own positions, they have to buy shares, but that buying pushes the price up, which then forces them to buy even more shares. And boom, you get this accelerating rocket ship of a move. So, there you have it. All the pieces are on the chessboard. This brings us right to the end game, where this analysis lays out two very, very clear scenarios for what could happen next. It defines the key battle lines that everyone should be watching. Okay, so here are the two final scenarios. On the left, you've got the bullish breakout. For that to happen, buyers need to reclaim the VWAP. That's just the volume-weighted average price, basically the stock's real average price for the day, at 247. Then they have to smash through that institutional wall at 254 and make a run for the $3 target. Now, the defensive plan on the right, it's much simpler. The big guys have to hold the line at 230. That's the price where they bought in. They have to hold it to keep this whole setup from falling apart. And really, that's the big question this whole analysis leaves us with, isn't it? Is this some kind of brilliant, meticulously constructed trap by Wall Street's biggest players, all hidden in plain sight? Or is it just a really compelling story, a retail fantasy? The battlefield is drawn. And what happens next in the price? Well, that's what's going to tell the final story.